Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. I hope you enjoyed today's episode with Evan Tindell. Evan and I have gotten to know each other over the past couple of years, and we hung out at Berkshire, had a good time. At least I did. No, I think he had a good time too. I digress. Anyway, Evan is a really interesting guy, and he's an ex-poker player, went to MIT. I pinged him because I wanted to have a conversation about thinking about bet sizing and portfolio management. He was willing to do so, and I'm really glad that he was because I enjoy talking to him a lot. So, without further ado, none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Please consult your financial advisor before making investment decisions and do your own due diligence. Thanks for listening. All right, everybody, this is going to be a good one. Thrilled to be joined by Evan Tindell of Byreem Capital. Evan is a very cool guy. I've gotten to know him. When did we meet? Like probably a year ago, and then we actually met at Berkshire.
Yes.
But I think I did something stupid like pitch you Altice, and you were like, no, man, I'm good without the leverage. And you were right, and I was wrong.
Well, Comcast hasn't been doing so well lately in terms of stock price. So we'll see how, right to not be an Altice, I guess. But
sometimes when blood comes for a sector, all you can do is try to hide.
Yep.
So do you want to give a little bit of your background and how you got into investing?
Sure. So I went to MIT, and there I learned how to play poker from some friends. It's sort of the cliche, like MIT gambling. Everyone always asks me if I played blackjack, and I try to explain that like poker's just a way better game to make money at because you're playing against other people. You're not like trying to play the house where you're gonna, at best have like a 1% edge. You're playing against drunk idiots that are coming from the blackjack table. And so played poker. Started playing poker at MIT, and was making a decent amount of money doing that. And so I was kind of toying with the idea of going on, doing various trading jobs on Wall Street, but decided that I would rather make a similar amount of money and not have to go into work and do it from anywhere and travel. And because I was playing all online.
How many hands would you be playing at once?
It depends. Sometimes I would be like grinding 4 to 6 tables of like $1,000 buy-in. So like 5-10 blinds, no limit, $1,000 buy-in. And then other times I would be like playing, 1 or 2 tables of like $5,000 buy-in. So it just would depend on like what the good games were going at that moment. And because different games require a different amount of attention, and sometimes there might be like one. Usually there wasn't even 5 games of $5,000 buy-in like going on the internet. So you would just play 1 or 2 and focus on that if that's was the best game. So it just depends.
Is there like a sweet spot of people that have? I mean, I know there is, but how would you think about the sweet spot of people that have enough money but no skill?
Just in general, the games tend to get more difficult as you go up in dollar amounts, with some exceptions. But just because like the really bad players, usually there's like a relationship between like the net worth of the person and like how reckless they're willing to be in like whatever limit game. So, some guy that's worth $10 million sits down at a $5,000 buy-in table and like just can, is going to could blow 20 grand and like not think twice about it. And that's not everyone, obviously. Most people, even 90% of people that are worth $10 million still think twice about blowing 20 grand. That's probably how they made the 10 million in the first place, right? But
yes,
but there are some people that don't think like that, right? So the lower limit games are always a little bit crazier just because, the average person, like just anyone can sit down at a $50 buy-in game and go crazy for a few hands because it's not going to change their, whether they can put food on the table, hopefully. And so, although that being said, there would sometimes be like really like if you're, I played mostly online, but so it was more obvious when this would happen in person, but like where like a really big like whale like would just come in and sit at like $2,000 buy-in or $5,000 buy-in and just do like absolutely outrageous stuff. Like I've actually played poker with Dan Bilzerian. I don't know if you know.
Oh yeah, I know him.
Yeah, I mean he's pretty. Yeah, he's got like 28 million Instagram followers or whatever. Yeah, I was once at a table where it was a 9-person table, so you can play poker with 10 people, but a lot of the tables in Vegas are nine-handed. So it was at the Bellagio in kind of like not the really high limit play area, which has like a glass wall around it, but just like the slightly higher limit where you have to step over a step that's like this big. It's not really a barrier, but like it feels. I don't know why they do it. But anyway, we were in that area and at a 9-handed table and playing $5,000 buy-in, and Dan Bilzerian walks in with like just like a stack of. I mean, he had $25,000 chips and just like a stack of them, and everyone at the table was like, "Yeah, this is a 10-handed table now." That's like what's happening now. Like
we're gonna let him sit.
We're gonna like scoot over. He's not gonna have or someone at the table is not gonna have like a proper like drink holder. You know?
Yeah, so we don't need to drink for these next couple hours, folks.
You're right, exactly. So we all kind of moved over, and he sat down, and he's interesting. He's not dumb by any means. Like he, at the poker table, at least he was. But he was just pretty reckless, and so he was a quite good player to have in the game. And yeah, I've heard that he claims that he would kind of like not necessarily do that well in the casinos, but like win a lot of money in some of these private games with some like real idiots, which could be true. I have no idea. He definitely wasn't the dumbest. He was far from the dumbest player I've ever seen sit down at that table. So it's possible, but who knows? But there was actually a hand where I have a picture of this on my phone somewhere. I think it's actually in a Flickr, which probably is dead by now. Where there's a photo of him. He like convinced everyone at the table to just put out $500, like just as like blind. And we did this like blind hand where like everyone like reveals one card at a time where no one has seen their cards yet. And there's no like betting, but you just go around until, and then it's Texas Hold'em. So 3 cards in the flop, and then everyone's like turning over their own cards like in order around the table. And then whoever like has the best hand at the end just gets like $5,000 from the middle because it's like 10-handed. And while we're doing this, like people start to like come over like to like see what's going on. And so I have a picture of Johnny Chan, who's like, he was in the movie Rounders. I don't know if you know who that is. Yeah. He's like 19, probably like 1994 World Series of Poker like main event champion. He was like there's a photo I have of him looking over Dan Bilzerian's shoulder at his cards to be like, what is going on at this table right now? So,
those are fun times.
Yeah. So, all right. So we got on a little bit of
a little different. No, I like it because I'm all right. Let's get into investing, but I find it an interesting background that you bring to the table.
Yeah, and I think there's a lot of there is a lot of overlap in sort of like different concepts with poker that we can get into. Like the main one being that like people just like in investing, obviously people trade way too much. Like there's just bias towards doing something. Like people can't just like sit there with their 10 like decently priced stocks and just kind of like go on vacation. And in poker, it's the same thing. Like the main problem that 90% of people have is they can't fold. Like they're there to gamble.
Huh, that's interesting.
They're there to gamble. They're there to play. They're not there to sit there. They're there to play, and so they're calling raises with 5-7 or 3-7 or whatever, and they just lose a lot of money. They get in a lot of trouble that way. So I was making some money playing poker, very stupidly living in New York City, because when you're making 6 figures as a poker player in your early 20s, you just think like, I could have lived anywhere. I could have lived at home in Florida and just like banked all that rent money, I mean,
why would you though? You're young.
Yeah, I was young. I had friends in the city. It seemed like the right thing to do, but it was definitely pretty silly. I don't think I took, like now I go to New York and I take the subway, but back then when I was 21 and like making, what at the time was a good amount of money, like I took cabs everywhere.
Yeah,
I always took taxis.
Young people aren't the smartest with money. You're not alone.
And like when you're gambling every day, I mean, it's actually a cliche with poker players because, they're, you're gambling every day. And like part of what makes you good is your ability to divorce yourself mentally from the value, like, it's like you're not like, ooh, I'm betting, I've got to call $2,000. You're just like, okay, what are the odds here? Like, what are that? Like, what are the pot odds I'm getting? And like, how likely am I to win the hand?
Huh. Do you think that's helped? I mean, that skill has definitely got to translate.
Totally. Yeah, it does because, I mean, obviously in investing, you can't be like, ooh, I'm investing $5 million in this. Like, I better be like scared about it or something. Like, it's just, you just have to make the best bets at all times. So there's that aspect. But what I actually think is almost like more important is the necessity in poker of always updating your perceived odds of the situation at every point in the hand. Because like you can start the hand with, this is another thing that people get way wrong in poker is they're not willing to there's a combination of like sunk cost fallacy and probably and some other biases that feed into this, but they're just not willing to update the probabilities as they go along. Usually, like if they have aces, they're seeing them to the map. Like, you know what I mean? Like, it doesn't matter what the action is, like how many people are raising after the flop. They're just, they're not willing to update the probabilities based on the new information because it's like, it's sad. It's a sad thing that they have to fold aces, right? Like, that's like you don't get aces that often. Like, you can sit there for 3 hours and not get aces. So to fold aces is very sad. And most people just can't do it. And like, I think similarly to investing, it doesn't matter like how cheap the stock seemed when you first bought it. You know what I mean? Or how good the business seemed, right? Like, if you have new information, you have to update the probabilities. And I mean, the thing that's really hard in investing, and I wanted to talk about this later, but we can just get right into it if we want to, is the hard thing about investing is there's a second factor, which is the price is always changing. It actually doesn't matter. It actually doesn't matter if you're now like the thesis you had in the beginning is no longer valid, because what matters is the thesis relative to the price, actually. And if the price has changed a lot, then the thesis is that's required to make it work is different. It's like if the stock trading at 10 times earnings and stock trading at 30, I feel like this gets lost a lot in investing. Like, a stock that's trading at 10 times earnings needs a different type of thesis than one that's trading at 30 times earnings. Like, if it's trading at 30 times, I need to hear about like, industry growth rates, market share, like TAM, like all that, like margins, they need to be growing. Like, you need like a lot of things to go in your favor. Where if it's at 8 times earnings, you just need the business to not decline. You just need like their current customers to stay their current customers. And, the problem is when something starts to go awry, there's another bias, which is investing, which is not wanting to let go of losers, because there's always this hope. It's called the disposition effect. There's always this hope that like things can turn around, and like the mind is wired to try to like, because it's not like in your mind, there's this bias towards like it not being a real loss if you haven't sold it yet. So people tend to not sell things when they should. And so people try to fight against that with the heuristic of always sell a broken thesis. So that's how people try to fight against that. You say, okay, well, if the facts change and I have to have a new thesis, then I just sell, because what are the odds actually that like out of all the stocks in the world, this one that you were already wrong about is now a good purchase with completely different set of facts, and that you're not just succumbing to to just the disposition effect where you just don't want to admit that you were wrong. I
think, I mean, the one thing that I would say though is if you're buying a stock for 8 times earnings, you do need the current business to not go away, but you also need the capital to be returned to you, right? Like, there's gotta be some alignment of management and minority shareholder outcomes, right? Because otherwise you can lose all the theory in reality.
Yeah, I think that's definitely true. Although I feel like that is sort of equally true for stocks trading at 30 or 40 times earnings. Because like, okay, yeah, they're going to have all this growth and blah, blah, blah. But like, is that ever going to translate into free cash flow that gets returned? Or are they going to spend it on, and we own Facebook, but are they going to spend it on the metaverse? Or are they, you know what I mean? Or are they going to spend it on something else dumb to try to like keep that going? Or are they really going to return it? So I think that kind of cuts both ways, but it's a little bit more salient with the stock trading at 8 times earnings, because they're just closer to the point of needing to return the capital, right? Like with a stock that's trading at 50 times, like there's no earnings to really return, so it's not going to affect the valuation that much, or it's not as near term of a problem.
Yeah, I think the other thing that's kind of interesting is like with with something trading at 50 times, if they're investing and they can argue that the TAM is being created or growing, like people kind of like that, even if it's not necessarily provable at the moment.
Right. Yeah. There's at least a story there around why not returning the capital is a good thing. Whereas with a company trading at like 8 to 10 times earnings, like at least the market is basically saying that there aren't good reinvestment opportunities in the core business. So, you have to sort of prove why. It makes sense that the market, wants them to prove why giving it back is not the right thing, I think.
Yeah, that makes sense. So like, all right, continue with your thoughts.
Let's continue with I think that was a good tangent, but let's continue. So I was playing poker, was making some money, but in sort of 2008, 2009 era, so I've been playing for a couple years. Well, I've been playing poker for like 4 or 5 years by that point, but like just doing it like after college, like purely professionally, I'd been doing it for about 2 years. But by that point, some of the laws that had been implemented, which made it more difficult for banks to fund online poker. So online poker was kind of like a gray area, but then this law came down in 2006, which basically made it illegal for banks to transfer money onto the sites. Like it wasn't illegal to play, but like it was not, banks weren't supposed to allow it, basically. That made it more and more difficult. My theory is like that just made it more and more difficult for like the average Joe to put money on the sites. So you had to find this semi-sketchy Caribbean company called NetTeller, which was like a pre-PayPal or not pre-PayPal, but like sort of like similar to PayPal type solution to get money on the sites. You couldn't just like directly do it with a credit card or a bank, link. And so that just made it harder for the kind of the fish, I guess, to put money onto the site, the bad players or anyone really. And so what you had was the money just kept cycling up and up and up to better and better players. And by like mid 2009, I'd say the games were and it probably also the recession probably didn't help, but the online games were significantly worse than they had been before. And then you had the whole full tilt poker fiasco. I don't know if you heard about this, where they basically the owners were taking and this is just my recollection. So, if you're the former owner of Full Tilt Poker, don't sue me for defamation. But I'm not sure this is what happened. But I believe what happened was they were taking out giant dividends from the business, and then like one day everyone woke up and there was just a giant like FBI seal on the Full Tilt Poker website, and it just said like, this domain is now it's like under not investigation, but like FBI owns this now. And so you had to wait literally like years to get your money back. It's one of those things where I completely forgot about it. And then I got like an email years later that like, oh, by the way, here's like $10,000 from your Full Tilt Poker account from like back in the day, because they were able.
That's a nice email to get. There are worse ones.
Yeah. Well, the funny thing is that you get the email, but the email doesn't have the amount, and you have to like click through. So there's like this moment where I was like, how much did I have on there? So yeah, that was that was definitely nice. But I started thinking about what my next thing was going to be, and I had always kind of been interested in finance in college and earlier. And so, was kind of, I was just kind of thinking about it, still playing poker, but just kind of thinking about it. And my buddy, Ryan Ballantyne, my current business partner, was graduating from MIT that summer, in, June of 2009 or whatever. His dad had run a hedge fund that he eventually kind of returned into a family office in, I think, the early 2000s, but he had been running it since like the 80s or like early 90s. He had, interned at Fortress and, worked for a couple other, Wall Street firms. He was kind of debating whether to just go to a firm like that, like just like a separate Wall Street firm, or to go work for his dad. And he was like, his dad was basically a family office where it was like some administrative people and his dad doing like his dad was doing all the investing. And I think he kind of started thinking about it. He was like, do I want to move from Boston to Avon, Connecticut, and work one-on-one with my dad in the office every day, where it's just like the two of us, 10 hours a day. And he was kind of thinking, he was like, I think he was basically like, I need a buffer, but to have like,
that's fair. It's a little too much time together.
And he was 22, and I mean, so it's like, he didn't want to just be moving back home to just, languish in rural Connecticut at that age with no one to hang out with. So he convinced his dad to interview, some of his friends and whatnot, and I ended up getting the job. I mean, that's one of the nice things about going to MIT is like, just like your like random friends are like smart enough to do. Like, one guy I met at MIT who he tried to get me to join his fraternity was Drew Houston, the Dropbox CEO.
Huh.
And then I have another, a really good friend actually, who runs a crypto mining company. They like do crypto mining at stranded oil and gas sites where normally they would flare the gas. They set up these data centers.
That's smart.
Yeah, and they just got an investment from the Sultan of Oman, and in a like $375 million round valued at like a couple billion, I think.
Wow, that's awesome.
And he's just like a random friend I know from from MIT. So that's one super nice thing.
Auburn does not have that kind of network, but we do have Tim Cook, so we got that going for us.
Yeah, that's a pretty good. That's not bad.
I can't call him up though and say War Eagle. That does me no good.
Right. Yeah. Do they ever have like alumni events and things you can go to, or not really?
I haven't been anywhere that the Auburn degree has really helped me. I mean, in Chicago, there were like 15 of us or whatever. But I did get to meet Frank Thomas, and that was a nice conversation. But, cool. Didn't help me professionally.
Right. Well, all the more credit to what you've been able to do so far, I guess.
I guess.
It's all just your, skills of talking and knowledge and,
More or less. Mostly talking, less knowledge. But I have smart guests, so it helps.
So, so he basically, he got me the interview, and he hired me, and, I guess the rest is history. Well, the rest is not actually totally history. It's worth describing. So I was basically the sole, Buffett style value investing analyst on the long short portfolio. My buddy was more interested in, he's more of a programming guy. So he does more of the quantitative stuff, and still does today for us. We run a couple quantitative strategies that are just like pure software. But I was like the equity analyst. And so spent 7 years doing that from 2009 to 2016, which is a pretty interesting time for, investing in general, and pretty weird time for value investing, I think. And then in 2016, Steve, my buddy's dad and our old boss, was basically like, he basically kicked us out of the nest and told us to go start our own thing, and very kindly gave us an investment to like get us off the ground.
That's awesome. Well, that's sweet. So he basically helped train you, get your feet under you, and then he says, "All right, go do your own thing for
exactly.
You birds can soar now."
Right. Yeah. Which was awesome. I mean, it's not it's not too often you get. So, I mean, obviously it helps to be, the friend of the son of the guy, right? In terms of like him helping us.
Look, that helps you get the opportunity, but you don't keep the opportunity because of that.
That's right. Yeah. So, that we started in 2016, and we've been lucky enough to do pretty well so far. And the strategy that I run is called fundamental value, and it's basically, I mean, it's basically, it's a value investing strategy. It's long short. And what I try to really do is try to figure out why I think other people are wrong about whatever stock we're holding. So I try to really, think a lot about the sort of variant perception, which is like this Michael Steinhardt, idea. And even more than that, we try to, I like to be able to express our variant perceptions in terms of cognitive biases, because, I have this sort of theory that, like, and we talked about some biases already, like action bias and sunk cost fallacy and disposition effect and things like that. But, basically anytime someone's wrong, it's usually, at least if it's in a systematic way, it's because of some type of bias. Like, I mean, it could just be a simple bias towards things that are boring, right? Like, we sometimes call that like social conformity bias, or like availability bias, where like you're attracted to like things that are like flashy, or like things that are like available to the mind.
It's a lot more fun to be invested in something sexy. It's more fun to tell people.
Right.
It's more fun to follow. Like, there's a lot of reasons to not be psyched about like a garbage company, for instance.
Exactly. Yeah. And my brother is actually works for Waste Management Corporate, and yeah, it's like one of the best performing stocks of the past, like, few decades. And it's because, I think it's at least partially, it's because, I mean, and actually it's interesting. It kind of goes both ways, right? Like, boring businesses, not only does no one want to own the stock, so they might be a little bit cheaper, but people aren't, like, Silicon Valley isn't like funding too many, like landfill. I mean, there are probably some now, because it's like, probably going to become like a pressing issue, like waste disposal and stuff is like probably getting some funding. But it's not like the first thing that like rolls off the tongue of a venture capitalist, that like we're working on trash, right?
Yeah, no, the sexy thing is carbon capture, right? So if you're in carbon capture, probably capital going into that. But as far as like the actual storage of garbage, I don't think that's exciting.
Yeah. So we try to think really hard about the cognitive bias that might be at work in a particular situation, and like how that relates to our variant perception. Of course, you can trick yourself, right? You can like tell yourself a story about what other people are thinking, and it's not always, you're not always right about what other people are thinking. And sometimes people are right. Like, people are worried about something, and they were correct to be worried about it. It wasn't like some bias. So, but we feel like that kind of helps us avoid some value traps, and not just own things that are like strictly cheap, but like have like a sort of a second story around why we think they're cheap and why we think other people are wrong. And we just hope that helps us do a little bit better than a value index, for example. And we tend to own things that are kind of in the 8 to 12 times earnings kind of range, like cheaper than the market, but for what we think is a bad reason. Like, our kind of like our ideal situation is like, it's cheaper than the market for like a bad reason, and maybe we think it's actually a better than average business, but usually ends up being something boring. Although right now there's some, we own some Netflix and some other things, so it's it's not all boring stuff. Sometimes it's just stuff that people have gotten so beaten down on that they that it's just it makes them sick to their stomach. So it's that's the theory.
Do you tend to play around in a market cap? Like, do you target a market cap or not really?
We are agnostic to market cap. I mean, I honestly, I think that that's the best way to use your smaller size. I mean, I know obviously there's a good amount of data that small caps tend to perform pretty well over time, or outperform over time, and actually that they're cheaper than ever right now relative to large caps. So if ever was the time to double down on, using your small size to look at smaller companies. I think now is probably the time. But in general, I think that for my investing style, I like to look at large caps as well. And a lot of times you can kind of, especially with the whole cognitive biases framework, a lot of times you can figure out like what the kind of the market story is about a stock, just because there's more coverage of like a Netflix or a Facebook. And so it's easier to kind of figure out what like average Joe investor or like average Joe like sell side analyst is like thinking about the stock. Like in 2018 when Facebook had the Cambridge Analytica scandal, and everyone was saying like, oh, people are going to delete Facebook, and it's like this whole terrible thing. That's a story where you were able to see pretty clearly like what the bear case was, and like it was pretty obvious like why the company was in the news, and it was not for positive reasons. And we were able to just look at the business and be like, wait a second, half of people in the US don't even know that Instagram is owned by Facebook. So like, how are they they're not gonna delete Instagram, and like that's where all the growth is. So like, why are we so worked up? Even if some people, like 5% of people are gonna delete Facebook, they're not deleting Instagram. And people and the rest of the growth is overseas anyway, too, right? So like, I mean, obviously there's huge business in the US, and if half of the people deleted Facebook, that would be a real thing, but people didn't really care.
So when you're going through and you're updating your probabilities constantly, like how do you keep in mind like what is junky news versus what's signal?
I always try to bring it back to the numbers. Like, is this piece of news, is there really, like, you're a lawyer, right? Like if I'm the judge and the lawyer is, and the trial is about like whether this stock is undervalued, and the one side is in their closing argument is presenting this news article up to try to argue that like your 5 year out your free cash flow estimate 5, 6, 7 years out is different, then like what are you as the jury, I guess, what are you as the judge or the jury saying about this? Does it hold water or does it not? And you try to think about like, well, what would the lawyer on the other side say? Like, okay, and it's just like what I said about Facebook. Like, okay, it's people are saying they're going to delete it, but are they really deleting it? Like does anyone, like, okay, you see people talking about it on Twitter, but like, are your friends deleting Facebook? Like look at the actual data on usage, and try to bring it back to the actual numbers. I mean, very rarely, I think, do news articles that aren't actual earnings results move the needle for me in terms of how they make me think about the valuation. Very, very rarely.
That makes sense. I've been interested. I mean, I've followed Netflix. It's funny. I used to think their strategy was insane. Now I think it's genius. And now that I think the strategy is genius, the stock has cratered. And the news articles have gone from, like, I read one today that was like, well, no rational person thinks that Netflix could have kept that culture of, like spending and whatever forever. It's just kind of interesting how, like, I didn't read that in 2020 when the stock was going up, right? No one was saying, well, no rational person believes this is sustainable. So I find it interesting how often stock price really does drive the tone of what's being said about something.
Oh yeah, and I think it helps me so much to always look back at the numbers. Like, and like with Netflix, I mean, like, they earned $5 billion last year on 33, I'm just looking at Bloomberg numbers, 33.8 billion, and that's of invested capital, and that's net income. So EBIT was like 6 billion. So that's like almost over 20% return on capital. So like, the idea that this is not a good business is insane.
Well, somebody's going to come back to you and say, well, that's because you're under accounting for the amortization.
Totally.
So,
and I think that story is one of the reasons why Netflix is so cheap. And so I actually this is actually a great example of when you have a large cap stock that's heavily followed, you at least can know if the stock craters, you usually are going to know why, right? Like this is not like some stock that's just falling 50% in the forest and no one knows why. And maybe it's because like the CEO is stealing the company or something, or you know what I mean? Or like why Netflix cratered. And it's because people are worrying about increasing competition and like growth going forward, and people are worried about whether the net income will translate to free cash flow. And so you can like, I love situations like that because I can shoot against it, right? Like, okay, so you don't think that the free cash flow is like going to translate from the net income over time? Let's look at that. Why? Okay, and if you actually run the numbers, if you look at Netflix, and the problem is, this is a situation where the accounting is a little bit complicated, and it takes a while to like figure out that it's not as complicated as it first seems. And so their eyes just glaze over and they don't want to like do the hard work on it. But I think it's a very interesting example of like where if you like dig into it, you can kind of figure it out. And it's a perfect example of a situation where you, as like a small investor, you actually have just as much information as like Tiger Global or any of these like they're not going to tell me something about Netflix about like, maybe they've done some like survey data in Indonesia or something, but like the core business, like in the accounting, like the accounting is there to be had. And so if you look at Netflix's accounting, well, the main issue is that if you look historically, cash flow has not matched net income, right? It's lagged it significantly. However, during that time period, they were making a gigantic transition from licensed to owned and produced content. And so this is actually, different than whether it's like a sort of a Netflix exclusive. So like Orange and the New Black is owned by Lionsgate or whoever owns Lionsgate now. But it's a Netflix exclusive during the time period of the contract. It's not like The Office or something. It's like a Netflix show, right? But Netflix didn't produce it. So they didn't put up the capital for Orange is the New Black. They just licensed it for like 20 years or 50 years or something. Probably it will always stay on Netflix because, it's like branded as Netflix and, that's where people want it and Netflix can write huge checks. So it's definitely a negative expected value for them to take it off. But anyway, if you're going to transition for the next show to be completely produced by Netflix, that means you have to put up significant capital over a period of years and you have to do it all before the show gets released. And so what that means is, Netflix has an annual content budget of whatever, 20 something billion. They were transitioning from it being all back end to all up front. And so they actually went from $0 to $11 billion of unreleased production assets. So that's $11 billion they've spent on stuff that hasn't even been released yet. And so what that means is like the whole issue of how long they amortize things for, it's actually a non-issue with respect to the unreleased content, because like no one's arguing that they should be amortizing stuff that's not released yet, right? Like obviously none of the viewership has happened. Like they shouldn't be amortizing that. And so if you go back and run the numbers with that in mind, you'll see that if you kind of remove that effect, the gap between free cash flow and net income is much smaller. And they basically said it's going away over the next few years. And actually, like if you can run a model, and this is where it gets a little more complicated if you want to go this deep. I mean, you could actually just look at that only and say, okay, I believe in the amortization. Or you could say, okay, let's actually build our own model and see what we think. So if you build a model, I mean, I estimate that they amortize a little more than 50% of a TV show's value in the first year and like 20 something percent in the second year. So after 2 years, that they've amortized like 75 or 76% of the value. And to me, that seems pretty reasonable. And it honestly makes sense to me that would line up with viewership rates, which is what they say it does, but that's how they say they amortize it. And so I used to be kind of skeptical because I'm a big cash flow guy, right? Like there's tons of things that I've shorted over the years where they're bullshitting about the net income and you have to go to free cash flow to actually like, that's like a very standard like short thesis presentation is like, okay, net free cash flow doesn't match net income. Like, what's going on? Are they just storing things in inventory or whatever? But for them, I think it makes sense. And at the end of the day, like, I like the numbers check out, and I also trust Reed Hastings to do things well, just in general. And I don't, if you actually look at the numbers, if the numbers check out, I have no reason to doubt them. So at the end of the day, it's just the stock's trading at 20 times earnings, and they have this advertising opportunity, which, people will obviously spin as like, oh, they're like going back on their core tenant, and like they're capitulating. The business must be so terrible. It's like, or, they're just, they ran out of other growth options, and now they're running the numbers, and they realize that they did 1.3 trillion minutes of viewership in the US last TV season, which is like more than double CBS, and they got no ad revenue from that. It's a multi-billion-dollar business that they're just sitting on, right? And so, yeah, I mean, it's a pivot. Like, they said they weren't going to do it, and now they did it. But like, I don't know. Do you trust Reed Hastings to be able to hire ad tech people and along with Microsoft and kind of figure this out and generate like $5 to $10 billion of revenue over the next, call it 5 years? I mean, I do.
The other thing that I think is kind of interesting is, I'm not going to be the right person to push back on you on this.
Yeah,
I don't know. I don't own it, but I wonder why I don't, and I may soon. But like the Amort argument, I really think a lot of this issue and what people are debating now goes back to Charlie Munger's incentives question. And like when the market was rewarding them for sub growth, I just don't think people were sitting around a table saying, how can we spend more effectively?
Right.
And now that the market is not, I think that there's merit to the question. If you drop 8 episodes in a day, are you accelerating your amortization because you're burying what is otherwise? I mean, I see it with the podcast, right? Like if I dropped, or when I dropped a number of episodes a week, things would get buried.
Yeah.
Okay. But like, is there a better way to release things? Is there a way to stretch out the cadence of certain spend? Like, these don't seem like as hard of questions to me as how do I get to that scale? How do I get to that scale seems like the hardest question. How do I get to that scale while minimizing equity issuance seems like an even harder question. And now it's like, okay, well, how do we get profitable now that we're at this scale?
Right. And they've issued no equity. I mean, like,
yeah.
And
it's been insane.
And their earnings are real. Like, that's the thing people forget. Like they don't do the whole, they're famous for not really doing stock comp. I mean, like, okay, like for a Silicon Valley tech company, that does 30 billion of revenue, like the average one with that, you would probably expect them to be doing like 2 billion a year of stock comp or something. And it's like, it's 400 million. You know what I mean? It's not like a material, they don't talk about adjusted earnings that adjust that out. Like 5 billion is like taking that out, and it's, it's a real number. So yeah, I completely agree with you about, optimizing spend. Like, it was a land grab for a long time, and it's become clear now actually that the land that's being grabbed is not as large as people thought maybe it once was. And so, obviously that is a reason to sell off Netflix stock some amount, right? Because the pot of gold at the end of the rainbow is like probably not as big as maybe they thought. However, it's also a reason why competitors are going to struggle to invest as much to keep up, right? Like, I do think that the streaming industry is, as a whole, going to start to move a little bit more towards profitability, and because it's obvious that, like, well, if Netflix is like stalling out at like 250 million subscribers, then it makes a little bit less sense to go out and spend and like triple, quadruple our spending like year over year and just like fund gigantic losses. So I think there could be some positives, both from internal budgeting as well as the effect on competitors.
Oh, I think it's a certainty. I think we're on the right side of the capital cycle. I just don't think the headlines have come out yet.
Yeah.
And maybe they have through layoffs and whatnot. So, okay, right. So you get yourself to this stage. how do you think about like how good this set of cards is, for lack of a better term, and like how do you think about like bet sizing and when I pinged you, I said I'd like to talk to you about how you think about um, position sizing and managing a position throughout ownership. Um, the way I frame Netflix, and push back if you disagree, but leader in its category, growing cash flow, reasonable current valuation. Is that like a pair of kings? Is that a pair of jacks? Like where are we on how attractive this is, and how do you think about betting that?
Yeah. So the way I bet things.
It's obviously all opinion, by the way.
Right. Yeah. This is not financial
and
advice.
entertainment.
If you want financial advice, you got to sign a contract.
That's right.
This is not financial advice. This is just us thinking out loud, hopefully well.
Correct.
So bet sizing is definitely an art. I do think that there is some slightly weird attempts to make it into more of a science than it really I think can be. Like obviously there's the Kelly criterion, which talks about optimal bet sizing in like a very strictly known framework of probabilities and outcomes. But the Kelly criterion doesn't really apply to investing because you never really know what the probabilities are. And it's actually similar to poker in that way, right? Like if you're in a hand and you have pocket aces. I mean, obviously if you get your money in all in before the flop with aces, you can kind of have a good idea about what your odds are. But if it's on the flop, like you could already be beat or like drawing dead. So you just don't know what the probabilities are. They're depending on the person that you're playing against, whether they're a tight player or a loose player. You just never quite know. So you always have to be like way, way more conservative than like a Kelly criterion would maybe imply. And so for me, this isn't super scientific, but part of it's based on math. So if you look at the volatility of a portfolio that has 500 names and one that has 15 or 20 names, they're not that different. Like the vast majority of the benefit from diversification, statistically, if you start with one position, the vast majority of the benefit comes between 1 and 10 positions. Like obviously, it's an asymptotic thing. Like the biggest benefit is from 1 to 2, and then from 2 to 3, and then from 3 to 4. And so, as like essentially a single person team, in terms of the fundamental value strategy, I prefer sort of 10 to 15 positions because that gives me the combination of each one. Well, it gives me a combination of like, the benefit of diversification and just not like lower portfolio volatility, like lower risk of, severe impairment, and still having the ability to actually like know the things that I'm owning. So, it's a little bit of humility in terms of, because you can always be wrong. Obviously, if you were always right, you would just own one stock, right?
Yeah.
But I'm investing like my mom's retirement portfolio, like I have like my mother-in-law's money with us, etc. So I try to be a little bit conservative in terms of position sizing. But our biggest positions tend to be sort of 10 to 15% positions, and our smaller positions tend to be sort of 5, 6, 7, 8% positions. And then occasionally we'll go bigger. Actually, I know you mentioned wanting to talk about Twitter.
Yeah.
So Twitter is one of the few times where we've actually gone up to 20% for an initial position size, because that situation actually, I think, is one of the few that does lend itself to sort of like the known, because it's a merger arbitrage situation, the outcomes are sort of more known, and it sort of lends itself a little better to a Kelly criterion type analysis. Of course, if you put the percentages that I think are correct into the Kelly criterion, it'll tell you to put like 80% of your portfolio in Twitter, because it's like equal upside to downside right now, roughly, and probably like 80+% to win, So with those odds, I mean, the Kelly criterion is going to tell you to like go all in, basically. But so we were willing to put a little bit more of capital into that situation, just because like the outcomes are so known. But I think there's it's important to stay humble about what you know and what you don't know. And so like for the average position, that means for us like 7, 8, 9, 10%. But I think it's super hard to compare, because it's like, and what I do like estimated IRRs for every single position, so I can kind of like stack rank them in terms of like what I think the IRR is. But it's just such a guess as to like, okay, is my level of conservativeness really the same for all these stocks? Like, is my level of knowledge really the same for all these stocks? Like, is the edge cases, like, so it's hard to know. But that's what we do.
Well, I appreciate that answer. That's it's very honest to say it's hard to know, because that's how I feel as well. And maybe that's just me saying something's honest because I agree with it. But I think that's reality.
Yeah, there's a lot of bullshitting in the investment world about how easy it is to know things. You know what I mean? Like, everyone knows that their investment strategy and their choices are good when they're winning. And everyone knows that like they're just going through a bad period when things are going against them. You know what I mean? Like,
yeah, I do.
Like someone posted like a graph of Fundsmith's free cash flow yield chart, where it went from 5% to 2.5% over a period of like 5 or 6 years prior to this year. And this year it's gone from 2.5% to like 3 point something. And obviously the reason why that happened is because the valuations were getting higher and higher on his stocks, and now they kind of went in the opposite direction this year. And of course, the joke was like, oh, this is I forget what the chart was on the way down, but it was like, it's like temporary multiple compression, and like our businesses are so great that like they'll all end up doing fine. Well, when the yields are going up, i.e. the prices are going down. But when the yields are going down and prices are going up, it's all just, well, the businesses are great, so of course they're trading at higher valuations. They always should have been more highly valued.
Yeah. I mean, it's interesting. It'll be interesting to see what happens over the next 5 years. I mean, it always is. But I'm
just still waiting for. I'm still waiting for the. I think Kotu maybe said something similar to this, but I mean, so few people stepped up and said, like in these Q2 letters, they stepped up and said, "Hey, we should have sold at the top." Like, the valuations, in hindsight, valuations got really out of hand. We're not going to make that mistake again. Like, blah blah blah. Like, they just, I don't know. They just all say like, "Oh, our companies are still doing great," and like not even really mentioning that like there's this other thing called valuation, that where your companies can be doing great, but that doesn't necessarily mean that they're a good purchase at that price.
Yeah, I think the thing that's tough, where I've gotten myself on this issue, is I think that's true. What you just said is true. I also think that like people have mandates, and to step out of like quality investing to go into cyclicals or something, I might argue would be outside of the scope of a mandate for many managers, right? And that's probably on the allocator to be pulling money from one manager and diverting it to another. So sometimes I think when you read these letters, there's a lot that goes unsaid. And the more I'm in the industry, the longer I realize probably the heroes at the top are somewhat smart and somewhat in the right factor, and right. Take everything with a grain of salt.
Yeah, and I mean, it definitely, I mean, allocators have a tough job. They have a tough job, for sure. But, I mean, they completely just incentivize people to do exactly what you said, which is stick to the strategy, like stick to the marketing pitch, stick to the mandate at all costs, because that makes their jobs easier. It doesn't lead to higher returns, I don't think.
Yeah.
It might, but it definitely hurt them this time around, because like you said, like how many shops have a mandate of buy what you think is cheap, or buy whatever's undervalued, because pension funds, they want to know, like, okay, we have $100 million. We have $500 million invested in like these growth funds. We have $300 million invested in these value funds, and like they'll tend to have like opposite correlations. And there's benefits for the pension funds to be able to do that sort of analysis, to sort of, not have everything shit the bed at the same time, right? Because but it requiring that of the manager definitely decreases the opportunity set, right? And I mean, then there's definitely worlds where like tying yourself to the mast in that way removes some temptation to be a little bit more, I don't want to say, I don't know, like flighty, or like, because I mean, for most good strategies, it does make sense to just stick it out for a long period of time, like regardless of what's going on. And that's what the mandates are really trying to fight against, right? Like, they're trying to fight against people just doing things on a whim and like not sticking to. I mean, what they're really hopefully fighting against is the manager's desire to do the opposite, which is like pull out at the bottom. And like, you know what I mean? Like at least with the mandate, they can say, listen, this is what you're paying us for. We're going to keep doing it. And usually that is the correct decision, right? Because like the stocks are cheap now, right? Like the strategy is maybe cheap. But unfortunately, by doing that, you kind of tie their hands at the top as well, because they can't just come in and say, well, yeah, this has been working for a long time, but that's exactly why it's expensive now. And we should do something else. So I can see why allocators do it, but it's at the top, it really hurts the underlying funds that they're invested in, I think.
Yeah, Jim O'Shaughnessy has talked about this on his pod, where like momentum was just ripping, and somebody came in and they were like, yeah, we want to allocate to your momentum strategy. And he said, well, that's interesting. I'm not, right? I'm actually drawing money out of it and putting it into like small value, right? But, that's somebody that studies markets all the time versus somebody that's just looking at heat chasing.
Yeah, and that's actually one reason why I like having our kind of like pitch be something other than like we just buy value stocks, like where I have this, the idea is like, okay, cognitive biases and like variant perception and like trying to think about what other people are getting wrong, because hopefully that allows me to, I mean, it will hurt me trying to raise money with a lot of institutional allocators who just want to like put you in a box, but at least it gives me a little bit more flexibility for the people that do invest with me, because it allows me to take on opportunities wherever they are, whether they're like cement companies at 4 times earnings or Netflix at 20 times earnings.
Cement company at 4 times earnings. Interesting.
No,
I like the idea of that.
I just made that up, but like I feel like that's like the canonical, like, I don't know.
Yeah. So I was talking to our mutual friend, Elliot Turner, about Kelly betting. And something that he said is, what a lot of people don't think about is if you take the bet off prematurely, it messes up your Kelly formula, right? Because your risk reward has been truncated. Do you have any thoughts on that? Not that I need to have you in some random debate with Elliot who's not in the room, but when he said it, I thought it was interesting.
He is right in the sense that so let's talk about the Twitter deal, right? Let's assume for a moment that the upside is 54.20 and the downside, just to make the upside even to the downside, call the downside 22. Stock's at 38. So upside is 16, downside is 16. If like on a temporal basis, if you think that like the upside is unlikely to occur, like let's say you think they're not going to settle the case, like they're going to go to trial. So the upside is like probably some number of months out, right? Like the trial's in October, or at least unless he wins today, the right to push it back. And then there's an appeal, and that takes a couple months. So you're talking like December, at least maybe January, February, who knows, before you get the 54.20. Now, let's say you also think that like there's some time, like the time between now and then has the potential for there to be like negative surprises. If like, for example, Twitter's Q3 earnings are so bad that the banks declare a material they declare that like there's a material change and they can get out of their contracts or something.
Or the whistleblower, which
or the
came out,
whistleblower,
right?
Exactly, or the whistleblower. If you allow yourself to be exposed to those negative surprises, but you then sell the position in November before you, in like end of September before you can before you ever had a chance to realize the upside, then yeah, you can kind of. And I don't know that these assumptions actually apply to Twitter. This is a thought experiment. You kind of are cutting off your upside potential without really decreasing like the downside that you kind of risked along the way potentially. So I would kind of agree that that there's the potential for the upside downside to change depending on how long you hold it. That being said, for the average stock, where like I'm not really a big believer in Kelly betting for the average stock anyway, because the upside downside is not really known. I'm not sure how much that makes sense because, and even in the Twitter situation, right? Like the market eventually is a weighing machine, but it's, people are voting on what they think the outcome is going to be. And there's definitely potential for like upside surprises along the way that don't involve the court case, right? Like today is a good example. There's we're recording this on September 6th, 2022. And there's a hearing where the judge is going to decide a bunch of things probably soon with respect to the case, that if they all go in Twitter's direction, it's going to could speak to the judge's kind of overall opinion of the case, and the stock could trade up. So yeah. I think I see what he's saying. I definitely see what he's saying. Although I think in practice it's hard to know. It's sort of harder to know how much upside versus downside you're giving up by cutting a position short.
Yeah, and I guess that the way that you can reconcile maybe trimming a position and also what he's saying about the Kelly bet is, as the price goes up, your risk reward is sort of changed, and that would tell you that all else equal, Kelly would mandate like a lower portion of your portfolio should be bet in that way. So you could be trimming and following Kelly if you're reducing your size.
Totally. I mean, and just separately, like, yes, if you trim early, you might be changing like the risk reward of some bet that you made 6 months ago with this money, but that's actually irrelevant because what's before you now is a new bet with new prices, a new timeline, right? And so yes, you changed the risk reward from back then, but who cares? Because that's not the bet. You're not making that bet anymore. You're not presented with that bet, right? Like, you don't have the chance to go back and, buy Shopify at $2 or something 5 years ago. Like you have to, bet on the price today. So I completely think it's fine. I don't think, it's just that there's even if you are doing Kelly, there's just a new Kelly bet. There's just a new Kelly calculation that you have to do today. And so you're completely right that it's dependent on where the stock is trading and, what the upside and downside are from today. That being said, there's a huge bias towards selling too early, which is something to think about. And like what I try to do is, being a value investor, there's this tendency to have a forecast originally. And you're buying the thing, it's 8 times earnings, and now it's at 14 times, and you're like, okay, I'm out. It's no longer cheap. Based on my previous forecast, I wouldn't have thought it was cheap at 14 times earnings. So therefore, it's not cheap at 14 times earnings now, and I'm going to sell it. But there's a bias towards selling too early. And so what I try to do is, on the way into a stock, I'm trying to be super conservative. But if it's working in my favor, I try to increasingly sort of make forecasts that would allow me to hold it, basically. The hypothesis kind of the kind of like default hypothesis in my view kind of changes a little bit, and it's only because of this cognitive bias. If this cognitive bias wasn't there, I don't think this would be correct. But the cognitive bias is towards selling things too early, and some people they fight that by just saying never sell, right? Like that never sell exists because people are trying to fight a bias. I think if it's done if it's being done with any thought at all, because that's also not entirely clear. But
well, like Chris Cerrone at Acri, that guy thinks,
yeah, for sure,
right?
for sure.
Yeah.
So for the people that are thinking about it, for the people that are thinking deeply about it, I think never sell is being done to fight that bias. And so what I try to do is I don't quite do never sell, but if it's working in my favor, I just try to be conservative in the sense of not underselling the how well the company's been doing. Like, so if the company's been doing well, like giving them full credit for that in my projections and really seeing if there's a way for me to kind of hold on to the stock. And sometimes there's not, like straight up, like sometimes there's not. And, you know, and then, you know, you just have to sell and you just have to pay the taxes and you just have to, you know, get the calls from your clients where they're very, very annoyed that you're making them pay taxes on something that went up 7x or whatever, which is something that literally happened to me.
Well, taxes are very annoying, but if they're long term, they're less so.
Yeah.
I'd be fine paying taxes on a 7-bagger, by the way.
Right. Yeah, that's you know, I would hope that most people would be, but for some people, it's just easier to understand the check that they are sending to the IRS and feel that pain rather than like remembering what their account balance was the year before or what, you know what I mean?
Yeah. So how did you get the cojones to short the meme stocks? Or were they the meme stocks or were they just the really overvalued?
So we started in like late 2020 with just really overvalued stuff. And so, I mean, honestly, at my old job, we did a lot of short selling. So it was the long short portfolio. And yeah, I spent a lot of time on shorting. You know, my old boss was pretty bearish at various times and, you know, made a bunch of money calling some stuff that happened in 2008, 2009 correctly. And so we kind of always had this, a little bit of a bias towards like, you know, shorting and seeing the potential downside in things, which didn't always help us, but it definitely is a good way to think, I think, overall, even when you're trying to go along something. But anyway, so I kind of got a little bit disillusioned at my old job with shorting because probably between 2013 to 2016, like more and more, any kind of obvious short would have high borrow rates or would just be difficult to borrow or just wouldn't be there in enough liquidity. Like what Jim Chanos does is extremely difficult because of all that extraneous thing, those extraneous things you need to manage to run a short portfolio. That isn't just like picking the stock. It's literally like, how much is this going to cost me to short it? Like, am I going to be able to stay short? Is there going to be a squeeze, etc.? So I kind of shied away from shorting or doing much shorting when we were starting this business because I was a little bit disillusioned with it. It's just very difficult. And because like we were starting from scratch, like we were trying to start a business and, you know, I just thought it made more sense to focus on the long portfolio. And like nothing seemed that outrageously valued. Like, you know, we incorrectly thought for a while that like value stocks were pretty cheap relative to their prospects. And that, you know, at least, I mean, for our stocks did pretty well, but like overall value did not do well. So that kind of sentiment definitely turned out to be wrong for a few years. But then in late 2020, we were like summer, fall 2020, we were just looking at all the COVID winners and like all the other growth stocks and just being like, this is insane. Like, this is completely insane. I just can't, like, I remember thinking like, I just literally can't not short these things. Like, I'm sorry if it fails. I don't know what to say. Like, I just can't not do it at this point. And I don't know, that's like not really a good, but it was just all based on the valuations, right? I mean, you had, and like the SPAC boom, I mean, there was just all the hallmark signs of kind of a blow off top. And the short sellers had just been so burned over the years that they just weren't there. But like the Robinhood craze and the SPAC boom and all that stuff was just like, it's like sometimes when I buy a stock, I'll say that like the valuation and the stock and the story just kind of spoke to me. And I kind of thought that about the SPAC boom and the growth boom and all the crazy stuff that was going on like post COVID. It just spoke to me from the short perspective. I felt like it was like hitting me over the head. And so we just decided, I think it was like probably September or something 2020 to like put that trade on. And honestly, it was pretty painful for about 6 months.
Yeah.
I mean, obviously you could have been years earlier. Like when I was putting this on, I was thinking to myself, what happened to David Einhorn's portfolio and his shorts over the years was both the reason to not put on this trade and the reason to do it, because exactly what happened to him and his shorts was the reason to not put it on, because like, you know what, there are great companies out there and they surprise you to the upside, and Jeff Bezos and Reed Hastings and all these people are actually amazing. And shorting them is very dangerous and, you know, can really hurt you. However, that, like, a good thing can be taken too far, right? And like that idea had been taken so far that it was actually very difficult to lose over the long term, like shorting the things in 2021 that we shorted, I think. And so like so many shorts would like look to like a guy like David Einhorn and his results and be like, yeah, see, this is why we don't short anymore, because it's like you're just gonna get annihilated. But that created like that created just a gigantic opportunity, I think, to kind of do the opposite of that. And so that's what we did.
And like when you put that on, I mean, I know nothing about running a short book, so I mean, how much brain space does that take to make sure that like things aren't just moving up parabolically against you, or is it one of those things that you're like, the short gets more attractive as that happens? It just seems...
Yeah, I mean, the difficult thing... Well, okay, let's talk about 2020 and 2021. I mean, honestly, those valuations that we were shorting things at were so ridiculous that like it did not take a lot of brain space to figure out that like Virgin Galactic, SPSCE, and like half of the other SPACs just needed to be shorted. So as far as like figuring out that these things should be shorted, that didn't take a lot of brain space. It does take some brain space to keep track of all these smaller positions and sort of think about like when you should be trimming them. Because I mean, yes, if a thing doubles for no reason, it does, or no reason that you can figure out, it does potentially make it a better short if it's just like pure air, like pure hot air. However, you can never, again, like we're investing like my family's money partially. I'm not going to like risk losing like 20% of capital on like a single position. So, so like if something goes from, you know, like if it's like a 2% position and it moves against us to a 5% position, like it goes up 2.5 times, we're going to think heavily about trimming that, like regardless of the valuation, because we just can't risk it. And that's the hard thing about shorting. Like if you're not decent on the timing, like you can get carried out just because of that factor, right? Like, you know, and so that's why it took us so long, honestly, because like we were thinking things looked kind of overvalued in 2019, 2018 as well, but like it just didn't quite make sense, and then we're all like kind of the hallmark signs. But yeah, these days, I mean, things are a little bit less obvious, but I mean, you know, you still got GameStop at what's GameStop at, 8 billion or something valuation. And so I don't think, you know, 7.6. I mean, the brain space to figure out whether that's a short is required is zero. Like you just have to have a functioning brain, I think, to know that that's a short. But yeah.
Unless they like do something where they ape it again or whatever, you know, and then you're like called out of it or whatever.
Yes, so that is the risk. That's the risk. I mean, I'm shocked that it's still trading where it is, although it is down 10% today. So that's nice.
As it deserves to be.
Yeah.
It deserves to be 50% lower, minimum.
Yes, for sure. I mean, the market cap in 2018 was 1.6 billion.
Yeah.
And sales,
that's crazy.
And sales was 20% higher. And they had $1 billion of EBITDA. So, yeah, it deserves to go insanely lower, but, you know, you do have to manage the position because you can lose a lot of money covering between when it goes to 5% and then covering again, then covering again. But I think, the shocking thing about GameStop, you look at the history of the markets, like usually the thing that happens once that's like really crazy, it doesn't just like immediately happen again, right? Like,
Yeah.
So the fact that GameStop went from, so the stock had a split. So right now it's at 25, but it went from, $2 to 80. And then,
jeez,
it went from $2 to 80, and then all the way down to $10, and then it went back to 70. All in 2021. That's crazy. And so it had this huge. They actually did do it twice. They did it like 2 or 3 times now. So that is a risk. But I think as time goes on, it kind of, it becomes less of a risk that they're able to have it go like up quite as high. Just because like the more people know about this game, and it's just a little bit difficult to try to get it quite as high, I think.
Yeah, that makes sense. The only one that I continue to be mad at for missing is Robinhood, but I also think that there were a lot of reasons for me to stay away. I was a tad too emotionally connected to that one to believe that I was seeing it clearly. But man, like when I was digging in on that thing, I was like, this is just DraftKings. It's just a casino masquerading as a financial product.
And you know what? That is a thesis that has worked a few times. Like DraftKings was a different. It was a regular casino business masquerading as like a different casino business, I think. And then you had Skills. I don't know if you heard of this stock, but they were a gaming company, or they are a gaming company, where it's like you theoretically like you do like real money gaming. They basically tried to make it like they were an esports company, but it turns out they were just a gambling shop. So like literally, like the idea was like you would bet $20 to play Tetris against your friend or something, and they were claiming that was like esports.
Okay, that works, I guess, in today's world. But I will.
Then that's an example. That's an example of like something that we shorted. Like that was a $7.4 billion valuation on $200 million of revenue and negative $90 million of EBITDA.
That's crazy.
That was on December 2020. That was a $7.4 billion valuation, and today it's $500 million.
That's nuts.
Yeah.
It's wild how it's wild how it can happen. Have you heard of FaZe? FAZE?
Yeah, the like esports gamer guy.
Yeah.
What's his game? I forgot what he plays.
I don't know, but I think that carried north of a $2 billion value. Oh, it's down 22% today.
Oh, that's the clan. Oh, interesting. Right. I've heard of this, but I thought it's a Counter-Strike clan.
Oh my. Wow, yeah, that's down from 19.
I thought it was like an individual.
No, yeah, there's a guy that I follow that was like, this is a terrible valuation, and then I pinged him and I was like, I think it's like, am I understanding this correctly? And he was like, yes, and I was like, yeah, that seems like a good short.
Wait, could you short that? Was that or no? Was that?
I don't know. I mean, that's the thing. I don't like check into the borrow or anything like that.
But that's a publicly traded thing.
Yeah, man, FAZE.
Wow, I did not even know that. See, that shows you how many crazy things there are out there. I've never even heard.
It's still got $1 billion valuation.
Wow.
If this data feeds right.
No. Yeah, that's what Bloomberg says too. I don't know what you got, but
yeah,
the short interest is 99.4% of the float.
That's a lot.
Yeah, that's a lot. That's a lot.
Yeah. I don't know, man. It's wild times. I guess it was funny when it was going on. I saw some of it. I missed some of it. I wrote down how I felt through a lot of it. So I think the next time that I can actually like feel greed inside my body, I'm just going to force myself to sell everything.
It's hard though. I mean, that is both an advantage and a curse that you kind of have as a someone that's like primarily, do you have clients or you just manage your own money?
No, it's just me.
Yeah. So that's kind of an advantage that you have as like just, managing your own money, where you can do that and there's no one to like answer to about like why,
But the other thing that I wrote, in the middle of the time is like, yes, I think a lot of these returns have been pulled forward, but I'm not. I mean, some of this crazy stuff I did not. I think I vocally didn't like as a basket. But like something like Charter at 800, which I sold, but I got into Altice, so that was dumb. I was like, I just don't see how the stock does well from here. On the other hand, like your opportunity cost is nothing was like really cheap, except for like energy. People are screaming at their headphones saying, energy and commodities. But I've never known how to play that game very well.
And honestly, I actually don't know. I don't profess to know how to really sell stocks. Like 90% of the time, I am trading into something I think is better.
Yeah.
Our like gross exposure will vary a little. Well, it does vary, but for the most part, when we make changes, it's like, it's just swapping one thing for the next, because it's just so much easier to compare what I think the return is going to be on some new stock than it is to just like try to think about like what to do with cash,
Well, that's what I think Munger would say to do, right? Is you have security that's your opportunity cost, and you weigh everything against that, and then make your decisions based on opportunity cost.
And for us, we have a little bit of the advantage. I mean, advantage depends on what the market's going to do, but like we can kind of express our view on how long we want to be by shorting things.
Yeah.
So that's kind of nice. So yeah, so we'll tend to do. I mean, that's basically what we did. In 2020, is we decided like, A, we want to short all these things, but and B, that'll help us not be quite as long, right?
Yeah. So your gross exposure will move based on how short you want to be on average.
Net exposure, but yeah.
That's what I mean. I don't know why I said gross. My bad.
Yeah.
Anyway, well, I want to let you get out of here and prepare. So if there's anything else that you want to talk about, but I know you got a big afternoon of watching some fireworks with Elon.
That's right. Yeah. I had a friend joke that they were going to turn it into a drinking game, which sounds kind of nice.
It's going to be interesting to watch, man. I feel like I'm taking crazy pills because, one, I think a bet on specific performance. I mean, you've got the richest man in the world with the best legal counsel negotiating against a multi-billion-dollar public company with the best legal counsel. Like, if this contract isn't enforceable, right, then like, what is?
Yeah, and of course he would argue like the contract is enforceable, and that's why the clause in the contract that says that we can get out if they made material misstatements, blah blah. But it's bullshit. Yeah. It's so transparently a pretext. It's just so obvious. Like nothing has ever been more obvious.
Well, and if you watched him on Twitter and watched in real time, it's just so hard for me to believe that that's an honest assessment of the situation.
It's blatantly lying. I mean, it's like as Matt Levine said in one of his emails. It's like, it's important to remember he's lying here.
yeah.
Like
that's right.
He said, it's like I tried to explain it to like, a family member or something. I was like, okay, let's say I wanted to buy your house, and I was like, you know what? This house, like, it's a good house, but it could really use a new roof. You know what I mean? Like the roof, it's got some issues. We're gonna fix it up. It's gonna be an amazing house, and everyone's gonna love it in a few years when we fix the roof. Then you sign the contract, and the local real estate market tanks, and you try to rip it up by saying, you know what? You didn't tell me how shitty this roof was.
Yeah.
Turns out the roof is actually pretty bad, and I did not know how bad it was. I've never been up on the roof, but I'm pretty sure it seems bad from here. Like, what?
Well, not just that. You specifically said I don't need to go up on the roof and check it out. Like, I'm cool with
you
the
offered
house.
Me to go up on the roof, and I said, nah, it's fine. It's fine. Yeah. It's crazy. It's the dumbest thing I've ever seen.
Nervous at all about the whistleblower?
I mean, anytime you got some...
It's not a great development.
No, it's not. It's not a great development, but we put out an update on our blog recently, and basically, like, if you kind of look at what he's really claiming, if that had come out, like things like that come out like fairly often about these social media companies. Like Facebook has had 3 whistleblowers at least that we know about. And I mean, if that had come out on like a random Tuesday, the stock might have moved like 3% or something. Because it's not directly relevant to like earnings, basically. Like it's not, I mean, okay, like he argued they have some like unlicensed software issues or something. Like, I mean, okay, like probably every software company has some improperly licensed, like semi-open source software that they're using. That's just like how things work. And so, and even like the FTC privacy stuff, like that stuff is a little more like directly relevant because they did, they just got fined by the FTC for violating the consent decree. So it's like very possible that it could happen again. But if you look at the size of the average FTC fines, they're like 100 to 300 million. And it just doesn't move the needle for a $44 billion merger or Twitter. It's not material. It's not a material adverse effect. Now, he's going to try to claim that like Facebook was fined $5 billion by the FTC, and therefore like $5 billion maybe is material to Twitter, right? And I actually saw Ben Thompson of Stratechery make a similar kind of argument about Facebook's $5 billion and how that could be, seen. But if you actually look under the hood, Facebook actually got sued by shareholders over that fine. And what happened was, basically, Facebook agreed to a fine that was 20 times larger than the FTC had ever gotten, and was like 50 times larger than what they would have gotten under their statutorily maximal $43,000 per instance fine. So like the FTC is not just not allowed to fine people whatever they want. It's like 43,000 something per instance. And the case law has said previously that that's like a per day fine. It's not like per like person that sends a Facebook message or something. And so when they were pitching the settlement to the federal circuit judge, they actually said, listen, this fine is so gigantic, it's actually more than any judge would have ever given us. It's actually more than statutorily possible, and therefore you should approve it because it's so punitive on Facebook. And there was a couple of the FTC commissioners, the ones that the Democrats that voted against it because it passed by 3-2. This fine, they were like, yeah, basically this was like a bribe so that Zuckerberg didn't have to submit sworn testimony and open himself up to personal liability in this matter. And they knew they would have never got $5 billion if it went to trial. So they just like made up this gigantic number so that Zuckerberg didn't have to testify. And so if you look at that, you're like, yeah, there's no way this FTC thing is really gonna. I know this is a super long-winded explanation, but there's no way an FTC fine would be large enough to matter here, and the rest of the stuff is kind of nonsense. And he basically admitted that Twitter was right about the bots. Like he admitted that Twitter was correct about the bots. So like, what are we talking about here? I don't know. I didn't find it too compelling.
Yeah, I was worried about it being a card that I didn't know how to handicap at the time. I do have this weird belief that I think Elon actually does want to own Twitter. I just don't think he wants to pay what he said he'd pay.
Literally nothing that he has done so far. I mean, okay, you could argue that like some of the stuff he's done could decrease the long-term value of Twitter because like he's disparaging it or like he's causing the SEC to investigate or whatever, but not really. I mean, like, really, the long-term value of Twitter is the platform and the users aren't going anywhere because of this. I mean, no offense to Twitter employees, but like the value is not the employees really, because like, I mean, Elon wants to go in and cut half of them anyway. That's kind of the whole point. So if some of them quit because he tweeted a poop emoji, like I don't think that really decreases the long-term value of Twitter. So if nothing he has done has really decreased the value of Twitter for 5 years from now, then everything he's done is entirely consistent with like a rational person that does want to own Twitter, but just not at this price.
Yeah, that's my read.
Yeah,
too.
it's just how LVMH did a whole song and dance about how terrible Tiffany was when they were under contract to buy that company during COVID. And eventually they just bought it for like a 3% discount. You know what I mean? They were like, oh, you guys managed it so terribly. It wasn't in the ordinary course. You like blah, blah, blah. They had a French politician send a letter about like why LVMH wasn't allowed to buy them. I don't know if you remember that.
No, I don't.
Yeah, look that up. It's hilarious. And at the end of the day, they just wanted a lower price.
What is this American trash? We can't have this American trash in our luxury brand.
We will dilute the culture of the... Yeah.
That's right. That's interesting.
Yeah.
Yeah, I have a couple people that I spoke to at Twitter, a lot more with the super follow stuff. Some of them have left, but slow execution will cost you a lot. So while I like them as people, I'm not sure that the value of Twitter is in the current culture,
right,
and all that. So
agreed.
Well, we'll see how it all plays out, man. I'm rooting for you to have a not too exciting afternoon. How's that?
I like it. I like that idea.
All right, sounds good.
All right.
Well, thanks for stopping by. I appreciate it. I'm glad we got to do this.
This was fun.
I look forward to hanging out in person again.
Yeah, man. Me too.
But it's absolute